US rate cut optimism continues to grow. The RBA was less hawkish than expected, but won't rule anything in or out. Australian consumers are really feeling the pinch, and inflation stays on target in Taiwan and the Philippines. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Senior Commodities Strategist Daniel Hynes says stronger than expected Chinese economic data is underpinning commodity prices, and that could continue.
Outside of the battery type metals, we're seeing copper and nickel and aluminium really be supported by this EV sector, which just seems to defy gravity and continue to get bigger.
But first, in 5 and 5 with ANZ, markets continue to be boosted by optimism that the US Federal Reserve's next move will be a rate cut this year as the US labour market softens. By 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.1%, while US Treasury yields were down between 1 and 4 basis points. European and UK stocks earlier closed at record highs. The Aussie dollar was down nearly 0.5% at 65.93 US cents, while the Kiwi was down 0.1% at 60.0 US cents. This was after the Reserve Bank of Australia yesterday left its key policy rate on hold at 4.35% and didn't talk about the possibility of rate hikes, as traders had expected. This sent the ASX up 1.4%. ANZ Head of Australian Economics, Adam Boyton, says there were 2 key takeaways from the RBA's comments.
Firstly, the post-meeting statement was less hawkish than I'd expected. And secondly, the near-term upgrades to the inflation forecasts are a lot larger than I'd expected. And so there's at the risk of reading a bit too much into all of this, that combination tells me that I guess the hurdle to increase interest rates further is probably a bit larger than the market might have been anticipating heading into yesterday's RBA decision.
Number 2, while the RBA's inflation forecasts were on the rise, indicators of consumer activity out yesterday were on the slide. Australian retail volumes fell 0.4% in the first quarter. That's the 5th fall in 6 quarters. ANZ economist Maddie Dunk says ANZ Roy Morgan consumer confidence was also down.
If you look at the activity side of the economy, there are some real signs of weakness, and the clearest sign of weakness is in the household sector. We're seeing consumption is really soft, spending and retail is also really soft, and it highlights that people are pulling back.
Number 3, Adam says that's posing a conundrum for the RBA.
That combination of weakness in the retail sector, but inflation persisting, that's an interesting challenge for central banks. Ultimately, though, if you do have such a weak consumer demand environment as we do have, it's very difficult for inflation not to moderate over time. It's just a question of when and how long does that take. And I think central banks globally and the RBA as well are attempting to navigate this question or this conundrum between how much do I need to depress an economy in order to get inflation down. And one of the things I think that the governor reminded us in the press conference yesterday was that, the bank is still trying to preserve as many of those post-pandemic gains in the labour market as possible.
Number 4, RBA Governor Michelle Bullock did say in her press conference that a rate rise was considered, reiterating the RBA was not ruling anything in or out. However, the less hawkish than expected statement meant markets lowered the probability of hikes.
Over the next year or so, it could well be that the start date to rate cuts is later than we might think, and that the entire easing cycle itself could actually be a little shallower. They're the risks at the moment. Our view hasn't changed, still thinking November for the first easing and 3 cuts in total. But if inflation's going to be higher for longer, then it's possible interest rates may need to be higher for longer as well.
Number 5. Elsewhere, Taiwan's CPI inflation rate for the year to April was 1.95%. Now, that was below expectations and took some pressure off the central bank to hike rates again in June. Meanwhile, ANZ economist Crystal Tan says a lower than expected 3.8% annual inflation rate in the Philippines shouldn't raise expectations for a monetary policy easing there.
Today's data will offer some comfort to the central bank. Underlying price pressures did continue to abate. Core inflation eased further to 3.2% year-on-year. But at the same time, with overall inflation still close to the upper end of its target band, it's still too soon for the central bank to relinquish its hawkish tone at its upcoming meeting.
Crystal Tan there. Now, in our bonus deep dive interview, ANZ senior commodities strategist Daniel Hynes says global commodity prices look set to be supported by a Chinese economy that is performing better than expected at the start of the year.
Certainly from that commodity perspective, I think the composition and type of growth that we're getting is quite conducive to stronger demand for a lot of commodities. And certainly, you look at the manufacturing sector, the PMIs now back into expansionary territory, above 50. We saw industrial production growth pick up. Fixed asset investment was also higher. But even if you dig further into that, I suppose the impact of some of those clean energy technology sectors continue to provide a fair bit of support. So while the number itself was better and it should support sentiment, digging into the detail suggests an even better outlook for commodities.
So there's strong growth in solar and wind capacity. How are these dynamics affecting demand for the commodities that are the inputs for these power sources?
The electricity demand numbers are sort of separating from that GDP growth number in part because of the electrification of the economy there. So the continued move to bring a lot of energy that had previously been consumed directly from gas or oil and coal, for example, into the electricity grid. For example, the demand coming from electric vehicles needing to be charged means that power demand is picking up quite strongly. That will obviously impact the inputs into the grid, and certainly oil and to a less extent gas will suffer as a consequence of that. But it's obviously resulting in demand for other commodities and non-energy ones in particular.
So with that strength in EV production, what commodities are being affected there?
Yeah, there was a lot of concern about the declining growth due to overcapacity issues, but we did see a pickup late in Q1 and into Q2. So that is relatively promising, and it's coming with some additional government support, which should see those EV sales remain strong. That's actually helped, obviously, the critical minerals in particular. We saw lithium prices fall quite dramatically last year, but we've seen a bit of a stabilisation and a pickup over the past couple of months now as demand there picks up. But even outside of the battery type metals, we're seeing copper and nickel and aluminium really be supported by this EV sector, which just seems to defy gravity and continue to get bigger.
So over the rest of the year, are you expecting extra stimulus in China to support commodities?
Yeah, look, I think they're still relatively cautious around providing too much stimulus. And so it's going to be enough, I suppose, just to meet their so-called GDP growth target of around 5%. So we don't see it lasting too deep into the year, probably through Q2 and Q3, which I think still should provide a bit of a backstop for the economic growth and also commodities themselves.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, May the 8th. Catch you tomorrow with a look at what the Bank of England and Malaysia's central bank do over the next day. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.